Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Roku reported earnings on November 2nd after the market close. And I can tell you, if you're watching this video, chances are you're looking at Roku stock price after earnings getting absolutely smashed is my guess. This is The Smattering. I'm Jason Hall. I'm here with Jeff Santoro. Jeff, we're going to take a look at Roku and tell folks our analysis of what's going on. Jeff, what are you seeing?
Well, the market reaction would tell you that this was an absolutely awful quarter, and there were some things that are concerning, which we'll get to, but there were also some things that I think are still bright signs for the company. So we'll have to talk about both sides of the equation there.
That sounds good. I'm going to pull up the shareholder letter right here, and we're going to get right to it, Jeff, and talk about some key numbers. So the company gives some key operating metrics, these three different buckets: active accounts, streaming hours, and ARPU, which is average revenue per user. And those numbers are a big thing that goes into the company's net revenue. So that's the first thing, right? So we'll look at revenue and then work backwards from here. Revenue, $761 million in the quarter, up about 12%. Revenue from its players actually declined. So that's the Roku hardware, right? It's either built in the TVs, have a licensing deal, or you buy the Roku stick that you plug into your TV. Platform revenue, that's their ad model, that's the ad-driven revenue for the most part, was up about 15%. Jeff, talk us through these key operating metrics up here at the top, and let's apply a little bit of analysis and see what we can tell the folks watching.
So if you read anything in Roku's SEC filings, their 10K, their 10Q, it's very clear that those three metrics at the top are what they look for. That's their whole business model is built around growing accounts, increasing streaming hours, and then monetizing those accounts, which is how you get the ARPU number. And although some of the other numbers in this quarter weren't great, I still think that these are pretty good growth numbers coming out of Roku, right? So growing active accounts, 16% year over year. That's not bad growth. Increasing streaming hours by 21%. That tells us that more and more people are watching things. And just that last bullet point, even above, streaming hours on the Roku channel, which is their own channel with some of the new content that they are actually creating. Like they bought the Quibi library, that grew over 90% year over year. So they're getting users, they're getting engagement. Now, ARPU is the red flag number here. That was only up 10%. And I say only because that's been decelerating each quarter for the past 4 or 5 quarters.
Jeff, I want to unpack that one a little bit, right? Because again, starting with this active accounts, growing active accounts 16%, I think you're right. I think that's really positive. It demonstrates that not only are people tend to stay with the platform, but more people are coming to it, especially when you look at the fact that streaming hours are growing faster. Correct me if I'm wrong, Jeff, but that means that the average account, the people behind that account are using it more than they did a year ago, right? It's not just adding new people that are using it about the same amount on average. They're using it more, right?
Right. Yep, correct.
That is a real positive. The ARPU number, though, that is an issue because what I look at that, and you would think streaming hours up 21%, that's a key metric because that's going to drive ads, right? Because that's ad placements are going to happen based on how much people are going to be on its platform, particularly with its Roku channel where it gets all of the ad placements on the Roku channel. The fact that average revenue per user grew 10%, correct me if I'm wrong, but that says to me either they're serving less ads or ad impressions, the per ad value has come down, or maybe more likely, maybe it's a combination of both.
It's probably a combination, but they do say in the letter, they're very upfront about the fact that they saw a softening in advertising, right? And we've seen this from a lot of companies, and I think we're going to continue to see it. That's just sort of the impact of the macroeconomic conditions that we're all experiencing. There's also another piece of the business too, where they monetize people purchasing subscriptions when they're on the device. So if you log on to, if you download the Netflix app on your Roku device and then subscribe to Netflix on it, they get a cut of that. So some of this could also just be consumer, spend being pulled back as people feel, economic pressures in their pocketbooks.
Let's take a look at a couple of more slides here. I want to bring up from their statement of cash flows here because let's be realistic with the company here. As much as there's a lot of good stuff going on with growth, the company is generating net losses. And then this line, let me embiggen this a little bit here. This line right here, net cash provided by operating activities, operating cash flow, has fallen substantially from, and again, this is for the first 3 quarters of the year, right? The 9 months ended this year. This number has fallen substantially. How are you thinking about that right now?
Yeah, I mean, the cash burn is not what you want to see. I'm actually kind of surprised that they have a little bit of operating cash flow on the positive side after the first 3 months of the year because of how everything has gone. But this is, this is the trend from the last year or so, where during the pandemic months and quarters, they were more cash flow positive than they had been prior. And now they're sort of reverting back to where they were before. So what I want to know long-term is, where is the actual real cash burn for this business? Is it closer to what we saw on the positive side during some of the pandemic quarters, or is it more what they were experiencing prior to that, when it was sort of back and forth every quarter, some positive, some negative?
Well, and taking it a step further, going from that operating cash, which was just a tiny bit positive, as we said, to free cash flow, the company spent about almost $100 million on CapEx for the year for, property and equipment, and $40 million investment as well. So you start backing those out, and then, negative free cash flow, right? And that's something to be really aware of. Jeff, the last thing I want to talk about before we wrap this up is thinking about this from a valuation perspective. I know price to sales is a pretty typical metric when we're looking at these not quite profitable on a GAAP basis businesses, especially the ones like you look at their platform margins are in the mid 50s. They've come down a little bit as ARPU has come down, and they're operating, some of their cost of goods are going up. But again, the idea is price to sales is kind of a starting proxy for a business that we think at scale can generate really good operating margins. And this is kind of where we are right now. This is, it's come off a cliff, and now it's trading for about 2.5 times sales. Make the case that this, whether this is a good entry point or a good point to add, or you think there's more questions that need to be answered at this point. Where do you stand on it?
I think if you believe long-term that their installed user base, who is now watching 21% more hours than they were a year ago, is going to eventually be there for them when the ad environment picks up and they're able to monetize, the monetization of those users is going to be able to pick up. If you believe in that thesis, it's hard to argue now is not a great time to look into buying shares, right? Because that price to sales of 2.5 is actually just slightly above the lowest it's ever been, which I think was like 2.2 in the history of their time as a public company. So, if you buy now, you're hoping that this is just a short-term dip and you take advantage of that, and you're hoping that the monetization is going to be there moving forward. You could make that argument again because of the other metrics that are trending in the right direction. But on the other hand, you mentioned the cash burn. They've been non-profitable on a GAAP basis. Net income there's been a net loss the last couple quarters. And one other thing that I think is just worth kind of keeping in mind as you're making that decision, their total operating expenses jumped massively this quarter. Their research and development was up 73%. Their sales and marketing spend was up 91%. General and administrative expenses up 33%, all on top of a quarter when revenue only grew 12%. So, that I think is another thing just to kind of keep in consideration. But, it could go either way. If this is really just a short-term advertising blip, now's a good time from a valuation standpoint. I think you just have to really believe that it is a short-term trend and not a long-term issue.